A handful of AI-fueled mega-cap stocks continue to power major indices to all-time high levels, while the rest of industries are grappling with higher energy costs, higher borrowing costs, slower growth prospects, and persistent uncertainty. So welcome to Swissquote's Daily Market Talk. It's Friday, 29th of May. I'm İpek Özkardeşkaya, and we will assess how expensive markets have become, what could go wrong, and challenges for portfolio management in this environment. But before we do, and as always, please keep in mind that opinions are my own, and this is not financial advice.
This show is brought to you by Swissquote.
So European stocks lost some altitude yesterday as the geopolitical headlines and a few economic data points released yesterday in the euro area couldn't spark much optimism. Consumer confidence and economic sentiment metrics in Europe remained bleak in May, while inflation expectations eased from last month's peak but remain notably higher compared to pre-Iran war levels. Across the Atlantic Ocean, while the data don't look better, though major indices traded up on a report that the US and Iran have extended a ceasefire and we're now close to an agreement. And yes, to answer your question, I haven't come across anything like this before. My 5 and 7-year-olds have stabler communication and they are also more predictable than this. But the most interesting message of this week, in my opinion, came from oil prices. Because despite political uncertainty and sticky points in the US-Iran peace negotiations, the primary two being Iran's nuclear program and the control of the Strait of Hormuz, while oil prices mostly fell this week. The week started with a 7+% drop in US crude, and we are presently more than 10% below last Friday's close. And that's an encouraging sign, mind you, because that means that the markets start, one, getting used to the headline volatility and react less violently to the news than in the initial days of the conflict. 2, investors are digesting the idea that the war will last a few more months. And 3, ceasefire and temporary restored traffic via the Strait of Hormuz could eventually pull and keep oil prices in a lower and a narrower range. Of course, given the chaotic nature of the negotiations, any unexpected development could send oil prices above that $100 per barrel psychological level again, because black swans are everywhere in the Strait of Hormuz, but below the $97, $99 per barrel range, including the major 38.2% Fibonacci retracement on the Iran-led oil spike and the 50-day moving average, while US crude remains in the bearish consolidation zone. And in the absence of fresh negative catalysts, we should see the price steady within the $85 to $90 per barrel range, and calmer headlines could even open the door for a further retreat to $80 per barrel level without necessarily having a deal in hand. Now let's leave the headlines aside. They just don't tell anything worthy, and look at the data to understand the impact of this geopolitical mess on economic activity and price levels. So the latest growth and inflation updates yesterday suggested that the US GDP grew slower than expected in the first quarter. We're talking about a 1.6% growth versus 2% penciled in by analysts. And more disquietingly, the core PCE prices, the one that the Federal Reserve watches to determine what to do next, have risen faster than expected to 4.40%. That's significantly higher than the Fed's 2% inflation target. Personal spending, on the other hand, somehow increased in April, but personal income stagnated, meaning that Americans kept spending, but they kept taking more debt on their shoulders, and sellers of affordable products like Dollar Tree, for example, or Best Buy benefited from the squeezed purchasing power in the US, and Dollar Tree jumped nearly 18% in yesterday's trading session on the back of better than expected earnings, while Best Buy rallied more than 15%. Overall, however, the US first quarter corporate earnings fell. They fell 0.4% versus a 5.7% expansion penciled in by analysts. It was the biggest surprise of yesterday's data, if you ask me, as it is also very much disconnected from the incredible performance of the S&P 500 companies last quarter, the 28% and plus earnings growth, remember, highlighting once again the widening gap between the technology-heavy mega cap benefiting from AI-driven optimism and massive liquidity inflows versus the rest. Because the non-technology pockets of the market, smaller companies and large parts of the broader corporate landscape are annoyed, obviously, with higher borrowing costs, higher energy prices, slower demand, refinancing pressures, obviously, and geopolitical and trade uncertainty. Meanwhile, the tech-heavy indices and tech headlines determine the main narrative, the one that pushed the S&P 500 to a fresh record high again yesterday. Snowflake, for example, jumped 36% in yesterday's trading session. Yes, 36% after the software company's results show that AI has indeed helped it improve its revenue rather than steal its business. Dell, on the other hand, jumped 39% in the after-hours trading on strong and higher than expected results as well. God bless AI. But anyway, yesterday's data still came as a warning that corporate earnings growth, as the markets rally, are not broad-based, but we already knew that. They are clearly driven by a handful of giant technology companies, while much of the rest of the corporate America and elsewhere in the world as well lag behind the rally. And it's not only the narrowing market breadth that is disquieting, it's also the rising leverage levels. One, the big technologies own leverage because the big technology companies are investing massive amounts to build AI infrastructure, increasingly financed by debt. And two, investor leverage, because US net margin debt hit more than 1.25% of US market cap by end of April. That's the highest levels in record going back to 1997. Last time the US net margin debt was this high was just before the dot-com bubble burst. So we keep turning around the question of, is this a bubble? As an economist, I will repeat that it isn't a bubble until it bursts. But a few signs are flashing red. One, the market breadth. It is one of them, obviously. The equal weighted versions of the technology heavy indices are lagging behind the technology heavy ones, and they do have good reasons to do so. And these reasons include rising energy prices, higher inflation expectations, rising global yields, deteriorating economic outlook, and so. Look, the gap between Kospi and its equal weighted version is especially worth noting. I mean, it's a huge and growing gap. In the US, Nasdaq's PE ratio has peaked to historically uncomfortable levels. And the so-called CAPE index, so the cyclical adjusted PE ratio, is about to hit the 40 level. And the last time this happened was during the dot-com bubble. Yes. And there's also the so-called Buffett indicator, which measures the total stock market's value as a share of the GDP. And that Buffett indicator has also surged about the 230% level. That's also the highest level on record by a wide margin, because if I give you a perspective, it's peaked around 130% during the dot-com bubble. Now, these metrics do not answer the question of, is this a bubble? And they do not necessarily mean a crash is imminent either. But they do suggest that investors today are paying significantly more for each dollar of economic output than at any point in modern market history. So what to do? Obviously, watching markets march higher without being involved is frustrating. So diversification and hedging strategies against a potential pullback are necessary. But the big challenge at the moment is that traditional diversification is becoming less effective because rising global yields are putting pressure on bond prices, weakening the classic stock-bond hedge, the 60-40 portfolio, just as equity valuations are stretching to extreme levels. Gold, on the other hand, which is another traditional safe haven and protection against a market meltdown and inflation, is testing its 200-day moving average to the downside as a higher real yield reduces appeal as well. But on the other hand, hard commodities remain interesting when inflation expectations rise. Look at copper prices, they're rising despite bleak economic outlook. Inside equities, focusing on quality companies with strong balance sheets and durable and stable earnings, diversifying across regions and sectors, I know it's difficult, and selectively using defensive assets that are not as shiny as a tech, but they could give you a defensive future, and also option strategies may offer better protection. It's easier said than done when the traditional theories no longer apply, but they're increasingly necessary to avoid getting caught on the wrong side of the trade. So I will leave it here for this week and let you think about it. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as you do usually. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next Monday, and until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.